Imagine a commercial airline pilot taking off from New York, bound for London. But halfway across the Atlantic, the pilot gets a sudden feeling that the weather in the Bahamas might be nicer, so they turn the plane around on a whim. It sounds ridiculous. In aviation, deviating from a flight plan without an emergency isn't just frowned upon, it is a career-ending offense. Yet, in the financial markets, traders do something similar almost every single day. On Sunday evening, when the markets are closed, you are calm, rational, and objective. You write down exactly what you will trade, where you will enter, and when you will exit. But on Monday morning, when the candles start moving and real money is on the line, that plan suddenly feels like a distant suggestion. You abandon your rules, chase a moving market, or hold on to a losing trade, hoping it will turn around. You end the day feeling defeated, wondering why you couldn't just do what you promised yourself you would do. Most people assume this is a simple lack of willpower. They think they just need to be more disciplined next time. But psychology tells us that relying on willpower when you are in a state of high stress is a biological design flaw. Your brain is not a single, unified decision maker. It is a battleground between two completely different systems. The architect is your prefrontal cortex. It handles logic, long-term planning, and risk management. This is the brain that writes your trading plan when the market is closed. The caveman is your amygdala. It only cares about immediate survival, escaping pain, and grabbing quick rewards. This is the brain that takes over the moment you see your hard-earned money fluctuating on the screen. When a trade goes against you, the caveman doesn't see a statistical probability. It sees a threat to your survival, triggers a fight-or-flight response, and hijacks your decision-making. Psychologists call this the hot-cold empathy gap. When you are in a cold state, calm and out of the market, you cannot accurately predict how you will behave when you enter a hot state of fear or greed. You genuinely believe you will follow your plan, but you underestimate how powerful the emotional chemicals in your brain will be once the battle begins. To solve this, professional risk managers do not try to build stronger willpower. Instead, they build systems that bypass willpower entirely. To understand how they do this, we have to look back thousands of years to a famous story from Greek mythology, Odysseus and the Sirens. Odysseus knew he could not resist the beautiful, deadly song of the Sirens. He didn't rely on his willpower. Instead, he had his crew tie him to the mast of the ship and told them not to untie him, no matter how much he begged. This is what psychologists call a Ulysses Contract, a decision made in a cold state that binds your behavior in a hot state. In modern trading, we call this the execution lock. It is the practice of removing your own ability to make emotional decisions. If your trading plan says your maximum daily loss is $200, you do not trust yourself to manually close your computer when you hit that limit. Instead, you program your platform or use a broker side lock that physically prevents you from opening another trade once that threshold is crossed. Professionals also use what behavioral scientists call if-then protocols or implementation intentions. Instead of writing vague rules like, "I will cut my losses quickly," a professional writes, "If the price touches $52, then my automated stop-loss will execute. I will not touch the order." By predefining the exact action to the point of automation, you remove the need for active decision-making when the emotional pressure is highest. This brings us to a fundamental truth. Trading is not a game of predicting the future, it is a business of managing operational risk. In any normal business, losses are simply the cost of goods sold. A restaurant owner does not cry when they have to pay for fresh ingredients, they accept it as a necessary expense to run the business. They don't try to save a spoiled apple just because they paid for it. They throw it away and move on. In trading, your losing trades are your cost of goods sold. When you fail to follow your plan and let a loss run, you are keeping spoiled inventory on your shelves, hoping it will magically become fresh again. To help you transition from an emotional speculator to a structured operator, we use a three-step framework called the execution engine. Step 1. Simplify the inputs. The more decisions you have to make during market hours, the faster your willpower drains. Limit your trading to specific hours and a single, well-defined setup. Step 2. Enforce physical boundaries. Use hard platform locks, automated stop losses, and daily loss limits. Treat these boundaries as concrete walls, not suggestions. Step 3. Measure your execution, not your P&L. At the end of the day, grade yourself solely on how closely you followed your plan, regardless of whether the day was green or red. A losing day where you followed every rule is a massive success. A winning day where you broke your rules is a dangerous failure that teaches your brain bad habits. Before we conclude, remember that trading involves significant financial risk. This video is for educational and psychological purposes only, not financial advice. Most retail traders lose money, and consistency requires time, study, and strict risk management. The next time you sit down at your trading desk, remember the pilot. You are the architect on Sunday. Do not let the passenger take the controls on Monday. Plan the flight. Fly the plan. We'll see you in the next session.